Hello, everybody, and welcome to BullionStar Perspectives. My name is Ronan Manley, and today we're delighted to have with us Daniel March, who's a specialist gold consultant. He's currently in Asia, and Daniel is actually probably unique in that he has worked previously for three of the big bullion banks in the London gold market: JP Morgan, HSBC, and ICB Standard. Actually at the coalface of the gold and silver clearing system that interfaces with LPMCL, and that is really at the heart of the global gold market. So hello, Daniel. Thanks for joining us. You're very welcome.
Hi, Ronan. Thanks for having me today.
Do you want to give a very quick introduction about how you ended up working for all these mega banks, the most famous banks in the London gold market?
It's so my background is in finance. I studied a specific finance degree back in 2006 in Portsmouth University. Studied topics like option pricing, capital asset pricing models, Scholes, Merton. So I was absolutely a pure academic back then. I went into work for Barclays 2006 in wealth management. Now I knew at the time, I actually did about 2 or 3 months there, and I was thinking to myself, I need to get myself into IB, investment banking. Now I worked down in Bournemouth. They had an operations unit, JP Morgan operations unit in Bournemouth. Now, obviously, I come from a pure academic background there. So when I initially applied, I actually applied for a job in fixed income at JP Morgan. This is back in February 2008. I didn't actually get the role, but they kept hold of my CV, and I got a call about 2 weeks later, and the head of operations at JP wanted me to come in. And I remember at the time, this is quite interesting, scratching my head thinking, I knew absolutely what I'd be doing in fixed income, because obviously I'd studied it all. When they said to me, you'd be doing something in the gold market, I started to think commercial gold. I had no idea what I'd actually be doing. And I think it's quite important. It's just what I'm trying to get at here. It's just not taught in the textbooks at all. Like the actual subject, there may be a brief reference to 1971 and Bretton Woods, but in terms of the gold market, in terms of how it sits and how it functions, it's just not taught. Absolutely not taught at all. So I'm telling you, I remember that date even till now. So that was 2008. I worked for JP, I worked for HSBC, and most recently ICBC. Now ICBC was quite interesting because that was we took where that was initially it was Standard Bank, and it was a Chinese entity came in and become one of the clearers. So that was quite an interesting experience. So I got exposed to you have to upgrade all the systems basically and become clearer. And actually the whole process of becoming a bullion bank is actually a big process. So no, I did that in 2016, left the industry then. I decided I just had such a passion for the industry. I just wanted to get involved more. I started writing. I think I wrote a few topics for Goldcore. I was on Zero Hedge a few times. And I've made some good contacts along the way. And I much prefer being on the visual side anyway, that's for sure. But like you say, it's quite a unique experience. Like I say, I actually worked in operations, so this wasn't trading, but this is the other half. But it's equally as important unit. I had a manager once used to say, trading can make 2 million, but badly run operations you can lose 4 million. So it's just as important having a good operations unit. So it was very interesting to be involved in that process for the best part of 8 years.
Yeah, I would say that you are one of the few people in the whole world really that knows how that engine works. Probably the only person who doesn't work in that area anymore, so it's free to talk about it. It really is a unique opportunity to share with everybody all of the real workings of what goes on in the London gold and silver markets. And the fact that they're the most important market for price discovery means that really everybody who has an interest in precious metals should really know how those markets operate and how the pricing is determined via the trading and clearing. So the first thing that I'm always confused about, and everybody else seems to be as well, is people have heard of allocated, unallocated in London, but really there is very little allocated compared to unallocated. And it boils down to what you call the gold credit unit that is created, and that is the unit that appears everywhere, either from the LBMA gold price auctions to the GLD settlement, to the EFP settlement, to literally day-to-day trading unit. Would you be able to explain how that operates? I saw some tweets and you were mentioning collateral of bullion banks, the fact that they have risk limits, the fact that they broker, and everything else beyond that has to be allocated.
Yes. Okay. So where to start? Probably the best way of thinking about this. Now, I think you covered this quite a while back. I think there's a study from the HRMC back in 2013. 95% of the over-the-counter, and when we say over-the-counter, this means not via an exchange. This is a bank calling up another bank and trading. Now, 95% of the banking over-the-counter volume is in the unallocated contract. Now, unallocated contract is where you would be credited those ounces on your account. If you don't allocate and withdraw, it's essentially exposure to the price and a liability to the seller on the other side. That's probably the best way of describing it. And really, when we talk about unallocated gold, we are talking about XAUUSD. That is the primary, price we're referring to there. And most banks are just trading that positionally. What I'm going to do in a minute, I'm going to talk about how that actually works through the gears and the mechanics without going too much into the nuts and bolts. I'm going to try and keep it as a high level as possible. But yeah, just a way to think about it. Yeah, that's the reason the term it gets used is paper gold, credit gold, because it's essentially, until it's allocated and withdrawn, it's essentially a claim. It's a claim on the collateral, and the collateral in this case is the 400-ounce London Good Delivery bars.
So some of the other names that you could call that unallocated credit would be like fractional gold, paper gold, synthetic gold, book entry units that are, do you think that they're actually backed by anything, or just a general intention that it's like musical chairs where there are 20 people running around and only one of them can ever sit down because there's not enough gold to back all of those claims?
Well, it's difficult to say for sure. The banks will have what's the best term to use there is working stock. And that is essentially the collateral on the unallocated trade flow. I'll talk about that in a minute of how that comes into place. Really what happens is after you say, for example, you have an unallocated flow. If I say, for example, I'm one bank, Ronan, I call you up and I want to trade 100 times. Once it actually comes to settlement, which is in 2 days' time, we're just going to settle that one flow. Most banks, part of their is they're going to have netting agreements in place. But what happens is, come settlement in a couple of days' time, you're going to have positions outhouse. When we took outhouse, I don't know if anyone saw my Twitter picture. It's a picture with AURUM in the middle and about 5 banks dotted all the way around. Now that's called outhouse. That's not the whole flow. That's basically flow that's actually going out the house. It's going into the market. That's going to be all over the place. The broker's process is all about getting that down to one position. Now, at the end of the day, at the end of the settlement day, once you've brokered those positions between the banks, you will be, as a bank facing the market, you are either going to be a net debtor or a net creditor. And based on that, you will be requesting with the other banks a allocation or deallocation. That's the moving of the claim on the, as you call it, the collateral, the base of the London market. Now, I know you've done some studies actually on this, and I think best way of thinking about this, you obviously have at the top the London total stocks, you have central bank holdings, ETFs, long-term holdings. The long-term you have to guess, you don't know what that is. It's not being reported anywhere.
It could be institutions or high net worth individuals.
Yeah. So really what you're left with is the working stocks of the banks. And I don't really know whether that's, when you're using the word free float, you're using the word free float, you're implying, so I don't know whether that's actually what the terminology is actually strictly correct, because you've got to think that is collateral on the floats. So you start taking that away. That is, you know what I mean? It's not, it's not.
I think that the concept of free float as applied to the gold market was probably terminology that was taken from the equity market, where if you've got like Tesla shares and 70% are owned by insiders, 10% by really long-term holders, that's 20% free float. So maybe it's a misnomer to apply free float, but it was something that was probably, it made sense at the time because it gave a concept that when you take away everything else that's not available, the only thing that is available is the free float. So
and one other thing, I don't know if anyone's read my tweet on this of the London mechanics. At the end, before that allocation, that's where you're making a claim on these bars or the allocation. there's going to be, the banks typically going to have settlement limits with us. These are dollar denominated limits. This is a tolerance for risk. And what I was trying to get across here is there's a level of judgment every day that's constantly changing depending on the appetite of risk. So what I was trying to get at here is there's elements of how much risk do you want to have on the zero risk? In other words, how much credit risk, how much exposure, overnight risk do you want to have on a claim on physical? And I think that's quite important. Particularly if we were to go into an extreme market, I think that's something that could change. So that was the point I was trying to get across there. One other thing I want to say about that is that visual we had, I'm not going to talk too much, but you had the AURUM in the middle and you had the 5 banks around the side. That's the outhouse, but there is in-house as well. So if you look at that on its own, that's only one part of the picture. In-house is, where the bank may have positions with their clients and so on and so forth. It's basically trades that are not going out of the bank. So when you're talking about the outhouse process with AURUM, and you say, position, it implies it's not the full picture. It's quite messy. It's quite messy to describe it, but I think probably just to summarize, it's unallocated credits. You got the net flow, and at the end of the day, for overnight collateral purposes, as a bank, you're a net debtor. It's just a shift in the collateral. It's shift in the collateral base. That's my understanding of it anyway.
Oh, well, I'm sure it is the right understanding because you worked in that area. Let's talk, just to remind people of what AURUM is. I'll just say a little bit of background about. There's a company called London Precious Metals Clearing Limited, LPMCL, which is a private company. It's like the old gold fixing and silver fixing companies. They were set up by the Bullion Banks, a little bit separate to the LBMA, but the same banks are operating the LBMA and LPMCL. They just wear different hats. That's a good way of looking at it. LPMCL created in 2001 this electronic matching engine system. It's probably a server that sits somewhere in a very secret location because they don't talk much about it. And all the banks send their trades or their netted trades in for clearing to this clearing engine. The clearing engine does its stuff, the algorithm maybe, and then creates those based on the risk limits and the brokering and netting, creates those end of day positions. Would that be, and the 5 members are JP Morgan, HSBC, UBS, Scotia, and ICBC Standard. So you worked for 3 of those LPCML companies.
Yes, and I started in 2008, and the key timeline there you highlighted was 2001. So AURUM is an electronic, you're right, it's an electronic matching system for the outhouse portion of the spot T+2 flow. Before 2001, it was done manually. It was called manual callover. So the banks, if they try to settle their trades, used to have to pick the phone up every day and tick back all their trades. But you're absolutely right. That is a system that's managed by LPMCL and I think LBT, I think.
Oh, that was the company that created the software or that maintains the server, maybe.
Yeah. So these guys, as far as my understanding, this is the technology guys though that manage AURUM, and if there's any problems should the system go down, that's the guys you call. But you're absolutely right. It's essentially an electronic matching system for not only the unallocated trade flow. That would include all of the broker transfers. That would include the allocations and deallocations. So if an allocation or deallocation, you'd be increasing your credit exposure or decreasing your credit exposure, and then a change in the physical part as well. That would all be reflected in AURUM.
It's fascinating in a way that the entire global market for gold and silver and platinum and palladium, just to remind people, this clearing engine clears the 4 metals. So one central system is responsible for literally price discovery in the entire global precious metals market. So it's pretty important. If that went down, that would probably create mayhem in trading.
Yeah, I guess it would. That's only Loco London though. So with platinum and palladium, you're right, but there is still some trade flow that settles Loco Zurich. Loco Zurich's not going to be on AURUM.
Oh, okay, because it's going to be in Switzerland.
Yeah, it's different location. But just as I was leaving, there was quite a big shift between platinum and palladium position Zurich, and the Loco London platinum palladium did start to take off. So maybe that is the dominant market now for platinum palladium. It never used to be. It used to be XAU USD London and the PG Zurich.
Is there some sort of protectionism in the fact that there are only 5 banks? I know there were 7 involved when it started in 2001, including Credit Suisse and Rothschild. Then Rothschild left, Barclays came on board, then Barclays left again. And there was also Deutsche Bank. So is it like the old gold fixing seats that there can only be a certain amount of number of banks? Or is it so capital intensive to have these risk limits that only big banks can even think about entering? And they would have to jump over a number of hurdles with the LBMA to be allowed into that club. It's like a club in a way.
Yeah, I think the latter is probably more correct. There is having been involved in it is super capital intensive in terms of, for not only trading, you'd have to set up physical management systems, in-house reconciliations, risk, KYC. It's a big project. Perhaps quite interestingly enough, I don't know how you feel about it, but 5-6 years ago, having a China entity join the LBMA, I'm not sure that would have been possible 10, 20 years ago. But I think at the core of this is I don't think there's a great deal of participants that are trying to join. Declining client revenue over the years or overall volume, the increased cost and oversight, and this is something I talked about with James Henry Anderson a few years ago. I think these issues are still at the core, where, in the back of my mind, I probably can only think of, at the moment, 2 banks that may want to join, because I don't know what's going to happen with Scotia. There's a few, but I can't think of a great deal that would want to. Yeah, it's a big obligation in terms of whether. Yeah, I'm not so sure on the first point, Ronan, but
yeah, there could be competitive pressure from another angle. Sometimes you see in the FT they mention that these banks in LPMCL, they do the bilateral clearing and everything is OTC. Some of the banks like Goldman Sachs at times are mentioned as thinking about a centrally cleared platform. So using the LME maybe. But I don't think that will ever get off the ground because the dominant entrenched banks in LPMCL don't want that to happen. So I don't think there will ever really be enough volume going through a cleared platform, like an exchange cleared platform.
Yeah, no, I agree. I guess, so I don't know, there might have been a number of automation taking place as well. So a number of the systems I am familiar with, or some of the systems and the mechanics I've just talked about, maybe some of those processes are going to get automated. But you're right, there is another contract on the LME, which is typically a base metal exchange, but the volumes, you're right, the volumes on that contract don't really exist, do they?
When we're talking about the gold credit unit being at the heart of everything, it's also at the heart of the Spider Gold Trust settlement and allocation, the GLD. Would you be able to explain a little bit about how allocation works with the custodian HSBC for GLD and the APs? Because that's a huge area of interest, but it's one that is full of misinformation or just misinterpretation.
Yeah, so there are, I think there's 12 or 13 authorized participants that can create and redeem shares for the holdings of GLD. But the key thing to think about here is the whole process is in unallocated credit. Now, even if I was holding on to physical gold and I wanted to deposit that into the system for shares, I would have to first deposit that physical, deallocate that into unallocated credit, transfer that to the relevant party, and that would get allocated and deallocated. The same is true on a redemption. When you're receiving the gold from GLD, you would initially receive unallocated credit that you would have to you'd allocate and then withdraw. So yeah, I think it's just being clear on the mechanics, and in terms of it's, for both ways, redemption and creation, you're talking about unallocated flow that you take to your bullion bank, and they can allocate and withdraw. So it's, but I think there perhaps is a misunderstanding that you just turn up in the physical,
Yeah, like sometimes you see people say that retail investors obviously can't redeem anything physical, but that a large institution could. But I think probably what is meant by that is that the large institution could have a side deal and be so large that it gets its unallocated credit and then separately goes to a bullion bank and says, can I change this into allocated? But it's nothing really to do with the redemption out of GLD. It's a separate process. What do you think was going on when HSBC looks like it had to allocate gold at the Bank of England sub-custodian rather than at its own vault in London?
I'm not entirely sure, Ronan. My guess is on this one. My guess is as good as yours on that one. I mean, you've been covering it quite well, haven't you, with the filings? Is this to do with the filing?
The GLD filings that come out every quarter. There was one at the, I think, end of April, one at the end of July. There's another one coming out in a few weeks. But in both of those previous occasions, the GLD had to reveal that it was holding substantial amounts of gold with the sub-custodian at the Bank of England, which suggested that they didn't have enough gold at that time in their own bank, their own vault in London. Well, it could have been due to the fact that there were logistical difficulties delivering to vaults during the London lockdown. But it is interesting that the Bank of England plays a role in, it's like a lender of last resort to GLD, as well as being a lender of last resort to the LPMCL clearing process. Because isn't it true that at the end of the day, if the banks have to allocate, like say Scotia and UBS, maybe they don't have their own vaults in London, so they could use the Bank of England to allocate. They could source gold at the Bank of England to allocate that collateral that they need in the clearing process.
For overnight collateral for the settlement process. Yes. All the banks will have, bullion banks will have accounts at the Bank of England. There's only 3 that have their own vault, but they will also have accounts there as well. They have accounts there.
Well, speaking of vaults, I think it's probably better if we don't talk about where location of vaults are. We might get kidnapped and disappeared by the powers that be, so we won't mention that. But talking about the London unallocated system, to me, it seemed to just appear in the 80s. I know from Bank of England archives that at the end of the 1970s and early 80s, there was nothing mentioned about unallocated gold. And it just seemed to appear at some point, a whole new system of gold credit. And a lot of gold bugs will always get very excited about the fact that unallocated gold being paper gold, it just was manufactured and there's a big conspiracy behind it. When did it start? And more importantly, why do you think it started?
In terms of the actual initial start date, it's very difficult to put the finger. I don't think I've ever seen anything written where it say this is the start date of unallocated.
I haven't too.
No, I haven't seen that anywhere. What I will say, I think it's pretty obvious that the popularity of the contract, late 80s, early 90s, that's when it taken off. Perhaps with the formation of the LBMA in 1987, that's going to be a timeline on this. Yeah. But you have to also think. I think JP might have developed their trading business late 1979. So that's another. It'd be worth checking the others. But really, my view on this is that you had a number of changes on how inflation was reported back in 1980. And John Williams over at Shadow Stats, he still keeps track of how inflation, how it was reported in the past. And the true loss in purchasing power. He's not picking these numbers randomly, and he regularly coming out with figures of sort of 8 to 10%. So I don't know whether that's potentially another timeline on this, where if you're structurally underreporting the true loss in purchasing power, and then essentially a financialization of gold, the financialization boom of the 1980s, where gold really was trading more as a currency, and it probably still does to this day. It's trading on, interest rate dynamics, real interest rate dynamics. I think all these things are linked. I think it's to do with interest rates, real rates. I think it's the financialization of gold. It's the explosion of derivatives, explosion of options. And looking at history from here, it's pretty clear that from maybe not the 80s, but certainly 90s. I mean, 90s is when a whole plethora of derivative contracts were created. So I actually think those 2 points together. The misreport. I mean, like I say, anyone living in real world today obviously knows inflation is not running slightly higher than what it is at the moment. But you have that what happened back in 1980, and I say that's the key. That is the key correlation for gold, dollar real yields, or sterling real yields. So if you have negative real yields at the moment of like 100 basis points. If actually we're saying it should be somewhere close to negative 6%, because these are a mirror. You have dollar gold up here, and real rates below. So clearly, if we are tilting that gradient sloping downwards, clearly we'd be talking about a much different gold price today. Obviously that true loss in fiat purchasing power would be represented. I think that and the whole financialization boom and the creation of all certain contracts makes me wonder whether true physical supply and demand fundamentals are being priced, or whether you are pricing ability of a market, market makers to be able to extend credit in the market. This is essentially a currency. One last point to add on this. It's quite interesting. We'll see gold. We think about gold. You've got XAU USD. The mechanics of actually settling that. If I want to send you dollars, Ronan, and I'd send a 103 or a 202. I don't know if any minute I know.
They're the Swift messages.
Right. This is exactly. This is the global payment system, right? But if I want to send to you XAU or US, sorry, if I want to send to you XAU or XAG, do you know there's a Swift message for that as well?
It's like a 60 something, 612.
Yeah. So 604 to pay.
Oh, okay. I think I came across that one time.
But no, sorry, I'm trying to make a point here. But it's just two sides of a currency pair. You want to pay dollars, it's 103. Swift. You want to pay gold, XAU in the current format, in unallocated gold.
So they're literally just electronic messages and flows of funds and nothing to do with physical metal. Currently, JP Morgan and HSBC are the two 800-pound gorillas in the London gold market. And now with Scotia leaving, there are less big participants. In the last few years, Barclays left, Mitsui, Deutsche Bank. Do you think that, and then we saw with the EFP blow up at the end of March that HSBC had losses. We can talk about that in a minute. But do you think that there is less liquidity in the market now in London because some of the big banks have left, or because of regulatory pressures or fines, they've been forced to leave?
I think overall, yes, over the years, that's been slowly declining. I think directly after the EFP in March, definitely. I mean, we were posting tweets on this. I mean, the over-the-counter volume dropped massively, didn't it? And then open interest in COMEX futures also dropped dramatically. I've been checking the data recently. It's come back a little bit, but it's still not anywhere near the same amount of gold credit as we're talking about 4 or 5 years ago. Last time I checked, I think the over-the-counter London market was trading, I think, only 100 million ounces a week, 20 million ounces a day. It's 40 billion a day. Silver is trading about 8 billion a day. I mean, not so long ago, we were talking about 200 billion being traded a day.
Yeah, well, the numbers are crazy and gigantic at any time in absolute terms. And the fact that a lot of this is just speculative bets, which you could look at really in terms of gold tons equivalent, because it's just a lot of gold credit, as you explained. But in a relative sense, it's shrinking. So that could be something that the LBMA should be worried about, or that might have knock-on effects.
Yeah, and in terms of, so you're right, absolutely. I mean, if you were losing a few participants in the market over the years, that's less participants you can trade with in the over-the-counter market. I think in some part that would be why you'd have more positioning going via EFP, going via brokers, because if you don't get in there first thing in the morning, you try and square out your positions. Tom next is T1, T2, or you can trade it in spot. Then traders going to be very unhappy if you start having positions in the middle of the day. Someone sends something through, but I think you're right. I think overall, yes, there has been a decline over the counter activity. It has come back a little bit recently, but I think it's going to be very interesting to see how that overall liquidity comes back next year. And I think when we're talking about EFP, perhaps worth mentioning EFP Monday, March 23rd. That is quite an interesting timeline. I don't know if you want to discuss that.
Well, I was going to ask you about that, but just quickly before we move on to that, seeing that we're talking about trading, volumes, liquidity, Back in a few years ago, LBMA had this project which they said was going to increase transparency, and they called it trade reporting. So everybody thought this is going to be great. They're going to release all the trades, like the way they do in the bond market, equity market. You could look up at Bloomberg and you could see every single trade. But that never materialized. What materialized was at the end of 2018, they brought in what they call trade reporting. So all the banks fed their trades into a repository, but LBMA just rolled up some very generalized figures, which to me don't make much sense, and released that publicly on their website. But then 6 months later, they actually closed down that public access and wanted people to subscribe for this information at something ridiculous like $1,500 a month. So what's your take on the fact that LBMA claimed that they were going to increase transparency in the London gold market, and then they really didn't, or did they? Does that information, if you subscribe to it, help traders or help institutions know about what's going on in the London gold market for spot, futures, forwards, or options?
So you're absolutely right. I believe so. You can get monthly trade data in one location. You can get weekly trade data on a Bloomberg subscription, and I think daily is on a subscription.
It's maybe for NASDAQ. That NASDAQ are the provider.
I would say the data was probably quite helpful for the forward market. So at the moment, they are giving you a gauge on what the forward OTC looks like. So if you've got positions 6, 9, 12 months, I would say that information to traders would be helpful. If, say, for example, they're doing less EFP COMEX, and if they wanted to square a spot position, futures, or having some kind of idea of, depth in the market going out. That being said, I think the trade reporting could be better. I think certainly, to be honest, I would like to see a breakdown between the 7 vaults, similar to the COMEX report, split down between eligible and registered between the 7 vaults. That way, you can tell me there's 8,000 tons in the London gold market, but unless that number doubles, you can give me that information today, or you can give me that information 3 months time. That's not telling me anything, right? It's 8,000 tons. I mean, that's unless it jumps to 60,000 or 20,000. Well, that's telling me nothing. But what I think would be quite helpful, I'd say, is if you could have those 7 vault locations or 8 vault locations, I can't remember at the top of my head, break down between, what's set aside for central bank, what's actually, working stock, or, that way you would have some kind of understanding or gauge of physical liquidity in London market. And I don't think all the current data is telling you is how many unallocated contracts are being traded backwards and forwards, whether that's T+1, T+2, 6 months, 9 months. I'm not getting any information on what's the physical liquidity. Like say, let's think about it. I mean, let's say money's not an object. I can turn up. If I turn up on a Monday morning and say, how much do you want to give me? I don't know how much. Do you know what I mean? I would like to know.
Yeah, it's totally opaque. Well, exactly. Like LBMA always trumpets the fact that they're being transparent, but it seems to be exactly the opposite. And as regards to vaults, I totally agree with you that if the LBMA came out with a report every day of its gold stocks, like the way COMEX does, per vault and eligible versus registered, what's just owned by somebody, and what is actually available for trading. There was a implication that they might have to do that if they started using London gold to settle COMEX contracts. I think there would be an obligation by the London vaults to have to follow the CME's COMEX system and start revealing what's in those London vaults. But I doubt if very many of those London vaults would want to do that because they seem to be super secretive.
I think one of the reasons you are seeing more trade reporting in the London market, I don't know if you've been following this, but there's an important date coming up for Basel III. So March 2021 is a date when the net stable funding ratio for gold trading. Now, I'm going to keep this as simple as possible. It's effectively the cost for the banks to trade. It's the cost of doing business. That is set to go from 50% to 85%. Now, this is not to be confused with 0% weighting on physical gold, which is correct. match with
That's
liabilities.
like a risk-free asset. So one is risk-free asset gold. The other one is to do with capital adequacy, is it?
Yeah, a good example here would be, say, for example, you are funding a mining outturn. You are funding today, you're funding the mine, and then 9 months in the future, you're going to get metal outturn. That cost factor of doing business, I think that's at the core is supposed to rise from 50% to 85. That's why you have seen these weird numbers like humid. I can't pronounce it. It's a liquidity ratio. So what the LBMA, I think, are trying to do, they're trying to lobby the European Banking Authority to get a nil exemption or lower that back down. The net effect of that, if that goes live, and I don't know if you've been following this in the LBMA, is really that's going to increase the cost of the banks doing business, which either the banks take or they're going to pass it on to the end user, the miners, the refiners, and so on. So I would keep that in your diary, Ronan, in March 2021. But with the last 12 months we've had, who knows, that might get pushed back later this year. But I think it's a very important thing to watch. And I honestly think that's one of the reasons, maybe the most important reason why you are starting to see more trade reporting come through. I think they're trying to show gold as a liquid asset that doesn't require that haircut.
So they're really doing it to create transparency in the eyes of the regulator, but not really for the general public or the wider bullion markets.
Well, yeah, I guess, yeah.
Let's talk quickly about EFPs.
Yes.
I've always been confused, and I think everybody else is, because of the name exchange for physical. So an EFP is a contract, a swap contract, essentially, that allows holders of COMEX gold futures to swap that exposure for London gold. So it's called exchange for physical, but it's not actually exchange for physical, it's exchange for unallocated credit. Is that right?
Yeah, I think the correct terminology used here should be it could be exchanged for physical. I think that would be the correct terminology to use, because the default is you are going to receive unallocated credit. That's not to say you can't allocate that, but that, yeah, I think it's just, yeah. It's
just a misnomer. So it could be like, as we were mentioning one time, exchange for paper. So, so in terms of what happened on the 23rd of March, you have a specific theory about, so literally everybody who's been on the BullionStar Perspective series in the last 2-3 months, I've asked them about their take on the EFP blow-up, which is when the future price, the COMEX futures price in New York diverged on the upside away from the London spot price. And it caused some sort of, it torpedoed some of the bullion banks in London. And there was a lot of scurrying around by the LBMA and the COMEX to try and really bury this and try and indicate to the market that it wasn't a big problem, which I think it was a big problem behind the scenes.
My take on it is I think primarily it was those few days. I think it was primarily a credit-driven event. I was asked a question, it's credit or is it? It's a physical event. Perfect example here would be so as a London bullion bank, you are naturally long Loco London. So you're long at 1500. But if you're short in the COMEX 1600, your balance sheet is out $100 every ounce for what you're exposed. So, I mean, we saw that 3 to 4 months afterwards, stories of 12 times far. So what would have happened, and this part I'm actually guessing, because I didn't work at the banks at that time. My guess would have been what would have happened at the time is these traders would have got a tap on the shoulder from risk department and has gone, hang on, what's going on? I thought we're long here, we're long short here. You know, it's creating exposure. So EFP being long London, short COMEX is now on the radar, and they would have been forced to scale back. So on those 2 days, no doubt you'd have had short covering in the COMEX. If you're short covering, you're buying into that contract as well. So that must have blown the contract out. But also, if you shrink, and after that day, if you shrink the amount of credit in the gold market, that means the ARBs, the opportunities to profit between London or COMEX or between the curve. That's why those ARBs stayed open for so long, because there wasn't the capital there to close out. But as what we found out from a few reports afterwards, if you had access to those facilities and you can get gold into Switzerland and you can ship it out, it's free money. And I think it was free money for a 3 or 4 month period. What I would like to say on this, actually, because I don't disagree with any of the commentary that's been added on this. I know quite a few analysts have talked about metal being shit, and I know some of the terms glut metal I don't really agree with, but and you're absolutely right. It's up to the shorts where they deliver into the contract. But at the core of all of this, and you've seen big delivery numbers.
Yeah, there was big deliveries, April, June, whatever, August. It continued. Yeah. It didn't just go for 1 month. It went all the way through the summer.
But you got to remember here, so the key thing to think about, Ronan, is ultimately, this is all to do with the longs. Like if the long doesn't want to take that contract into delivery, he can close it out or roll it. They didn't do that. They took it in. So regardless of what's happening on the short side, you have to think, why are the longs taking delivery? Why are they doing massive delivery? They got a choice. They can close that contract out or they can roll it. They haven't been doing that. My take on it so far is because you haven't seen the metal being actually leave the COMEX. I think for the best part of 6 months is a function of the current month and the next active month, which is 3 months out. So
it'd be like December now and February.
Right.
Yeah.
The spread had been, I actually did the math on it. The spread to roll 3-month contract, so you'd have to work out the interest times it by 4. It was coming out about 6 or 8% to hold a structural long position in futures 4 or 5 months ago. So I think enough traders figured out, look, I'm not paying 6 or 8% to be structurally long and roll a paper futures contract. I will take this into delivery and I will go from there. And I think that had a lot to do with, because you've got to remember is when they use the term delivery, not really delivery. It's just a claim
of delivery of warrants. Yeah, it's warrants changing hands in the vaults. Yeah. Yeah. Nothing has really moved out of the vaults yet.
Yeah, the metal hasn't left the vault. So, well, I think I think that's actually quite an interesting thing to watch over the next couple of months, because those spreads have come right back down. Actually, if I've ever got my screen, last time I checked, spot had actually gone under futures.
I think I saw World Gold Council tweet about that 2 days ago. That's something to look at later on. I might look at it later on today. Yeah. But I think what will be very interesting in the months, December. So keep an eye on December deliveries. See how many turn up. If it turns out we get record deliveries in the December contract, and the spreads are tight, and we're not seeing the metal leave the vault, then my theory probably needs to go back to the whiteboard. That doesn't make any sense. But a lot of things in these gold market are not making a lot of sense. Especially this year. 2020 is a year that does not make sense in any shape or form. Quickly, I was going to ask you about, so a lot of the silver-backed exchange-traded funds have had huge inflows of silver this year. And a lot of those silver ETFs hold their silver in vaults in London. But the sheer enormity of the amount of silver going into those vaults, where have they been sourcing that silver from?
Yeah. On this run, I'm not sure, because I'm not been close to the market. I don't know. What I would say though, have a look at because the LBMA do report a total stock report, and I had a cautionary glance at that this morning. The actual total amount of silver in the vaults from January to today, that seems to have declined. So this shift could only have happened, in my view, surely could only have happened internally within the system. So I think that's a topic for further follow up. You've had a run in silver from $11 from the low up to $29. So $29. So I think that's another that, and it's in of itself. I think will be a separate topic. I think that'd be.
I too haven't really looked very much into it. I just thought I'd throw in a question on silver because we were talking so much about gold. We're gonna probably wrap up in the next 5-10 minutes, but I had 2 more questions. One was to do with consignment stocks, because I know that as you worked for HSBC and JP Morgan and ICBC in London, there's a physical team in each of those areas that deals with sending consignment stocks to all these very exotic places like Istanbul, in India, Dubai, Singapore. What exactly are consignment stocks? Are they like just big chunks of inventory which the bullion banks leave in a vault in those local areas that they can then distribute out to their clients? How does all of that work?
that's my understanding of it. That it's absolutely that. So typical example would be, you have an Indian buyer, you would send typically 10 gram or 100 gram bar consignment to Delhi or Mumbai. It would sit in a vault in that location. Typically the buyer would then hedge that exposure, and then over time they would take delivery of those 100 gram bars, 10 gram bars, or whatever they purchased.
So would it be if the bullion bank retains ownership and then gradually sells this, or would it be the client that takes ownership using financing of the bullion banks?
Not
maybe
100% sure.
One or the other. Yeah, it's an area that because it's dealing in physical, it seems sometimes that people forget that bullion banks don't just deal in paper gold; they actually deal in physical as well.
Yeah, I mean that, and then they would hedge that side as well. So you'd have an unallocated side off that. Typically over time, they would, pay for that consignment and take delivery based on, jewelers and so on and so forth.
Okay, to wrap up, I was going to ask you about what you think of gold price drivers in the foreseeable future. You mentioned real interest rates, and we all know about QE continuing. Despite who becomes president of the United States, it's going to be like continued QE, continued stimulus, and then there's potential of inflation. So what do you think is going to drive the gold price? And do you think it's going to go higher? The US dollar gold price?
Yeah, I mean, so I think in the very near term, we're talking next couple of months, it's unsure because, I mean, if we get a spike in real rates, then it's potential you may see slightly further downside in the very, very short term. But you got to remember that's ultimately going to be met with more. If we don't get fiscal now, it's going to be met with monetary. I think the Fed will likely increase the 120 billion a month. That being said, I think a lot of focus this week has been on nominal 10-year yields, but actual fact, the real yields haven't really budged. And if you actually look at the real yields this week, they haven't really gone anywhere. So I think that's quite constructive. And also, and I think I was saying just before we had the call, I don't know if you're seeing this anywhere else, but Russia, I think Russia purchased 13 tons in October, which is their first purchase since March.
I haven't seen that. That's a very interesting development.
I saw it on a webinar yesterday. I'm not seeing it anywhere else. I'm going to try and get confirmation of it. But ultimately, this is going to be, the structural imbalances pre-election haven't gone, they were actually accelerated. The structural imbalances, we'll talk about the US, the structural imbalances were accelerating well before the US election. I think the repo rates going up September 2019 was an important signpost. And everything that's happened since there. So I actually think the risk here is the Fed could increase potentially even as close to December. I mean, if it starts to get even more messy with the election situation in the US, it's possible the Fed could pick up more, but ultimately more fiscal is coming. What I would like to say as well here also, if you look at gold in many other currencies, so gold in euros and gold in sterling are already 20 to 30% above their nominal 2011 high. Dollar reverting anywhere to 85 or 90 already implies a gold price around about 2,400. What I think also is very interesting to think about as well is what's going to happen to silver as well, because silver really took off in 2011 once it broke. So once gold broke 1,000, retested 1,000 and moved higher. That was the green light for silver to move from 18 to 50.
Yeah, I remember that in the end of April 2011. I actually got burned personally. I bought some silver, I think $50, and a few weeks later it was back down to 20s. So I'll never forget that time period.
What I think is going to play out this time around, I think it's going to be something similar. So I think once the psychological 2000 level gets taken out, more importantly, once it comes back down to retest that level and move higher, I think that's going to be when silver really starts to move. Once it becomes clear gold's not going back below 2000, I think that's the green light to CTAs, flow. And this is all about flow. Once, it's a much smaller market. Once flow starts to hit the silver market, it will move much faster. So, I've got very bullish outlook for 2000 to 2020, 21 and 2020. And I think the secular outlook it's all in place.
And just to wrap up, seeing that you're based in Asia, what developments do you see out there in Asia as regards bounce back in activity in the precious metals market, and anything interesting going on in either China, India, imports, premiums, anything like that?
Yeah, with China, they're coming out of. They've come out a lot. They've coming out of this, much faster than everyone else. Physical withdrawals in the Shanghai Gold Exchange have been relatively low, but what I had noticed, particularly for August and September, on the Shanghai Gold Exchange withdrawals, they were higher year on year. Also, you got a strengthening yuan. So I think there's potential there to see much bigger numbers. We've talked about the Central Bank of Russia. If that gets confirmed, potentially then they're purchasing annualized another 200 tons. I don't think it's going to be we're not going to be waiting too long before China comes back. And I don't know if you saw my tweet. I noticed an interesting trend where every sort of 6 to 7 years you get a massive revaluation.
Oh, I saw that. Yeah, they come out every so often with this huge announcement saying that they have 600 more tons or 800 more tons.
And I don't know whether that trend's going to follow, but I think there was big revaluations 2003, 2009. The last one was 2015, 648 tons. So, and roughly it doubles every time. And it's foreseeing, by the end of 2021, an increase from 1,948 tons they have now up to 3,600. If you think about it, that would actually put them second on the list, just above Germany. So it actually kind of makes sense on where they would want to be positioned. Obviously not more than the US, but also something else to think about. I know the gold price in China, the discounts have come down a lot. They were at $60 to $80 discount earlier this year. Now they come down to 20. Now I know you follow this as well. When the PBoC are buying gold, they typically do it gold for dollars, London, shipped overnight, doesn't go through customs,
flown overnight to Beijing.
But I was thinking about this the other day, Ronan. I can't see a scenario this year. But say, for example, you're a PBoC or PBoC proxy bank, right? You've got gold domestically trading $80 discount. Surely they've picked some up domestically. I know that's not what they typically do because they don't buy from the Shanghai Gold Exchange. I don't know if you've got any thoughts on this, but I'll be surprised if they haven't scooped up. You'll be given gold at a discount price, right?
Well, yeah, I think they're constantly buying, depending on the market situation, but they're always buying so as not to disrupt the market. I remember some quotes from some senior people from the China Gold Association or the PBoC, and it was actually Kuz Janssen put them together originally, and then we released them in the Gold Essentials on BullionStar Gold University. Some of those quotes from those senior officials said that they cannot be seen to be buying gold because it would disrupt the market. So they're probably in there under the radar, constantly buying gold, but doing so in a way that doesn't disrupt the price or doesn't shoot the price higher. Because if they were seen to be buying gold physical, it could send the whole market crazy. So they're being very long-term and they're being very cautious in the way they do it. So I think it's not impossible that they'd have 4,000 to 5,000 tons of gold or even more accumulated at this time. We've been talking for quite a while now. This is going to be great. I think the viewers are going to get a huge amount out of this. It's never been covered before, a lot of what we talked about. So Daniel, thank you very much for your time today. If you want to mention your Twitter name, people could maybe follow you after looking at this video now.
Yes, no, thanks for that, Ronan. So the Twitter handle is Daniel.March3.
Daniel.March3.
I'm pushing a sled for some reason.
Okay. So, yeah, great. And we'll talk again, but thanks for your time today.
Brilliant. Thanks, Ronan.
Thank you.